Cyber insurance. Cyber insurance is a rare growth opportunity right now for property and casualty insurers. Things are moving really fast in this market, I would say, at least since 10 years to 15 years. When academic literature looks at cyber insurance, first things that comes to mind is that insurers will be already playing a role of de facto regulator of privacy law compliance for organization, right? And a lot of people are also very optimistic about the ability of the cyber insurance market to promote cybersecurity and cyber hygiene within organization. So the question I'm asking today is, can we see the cyber insurance market improving organizational cybersecurity? So in other words, the way I'm framing the question is, can we see private insurance as a cybersecurity public policy? The way I'm analyzing the question first is through the idea of market construction. So for me, and for a lot of people, of course, markets are not natural. They're not spontaneous. They must be constructed by a lot of different ways. And perhaps one of the most important ways through which markets, such as insurance markets, are constructed is through policy, right? So I'll try to focus on policy analysis too. The data I'm looking at is very varied. So I'm looking at gray literature from the insurance, reinsurance, credit rating agencies, data analytics, also international organizations, of course, academic research and official statistics. So I'm trying to look at the perspective of both cyber insurance industry insiders and outsiders, and how they see the market developing and its outcome in terms of cybersecurity. So today, first, I'm going to talk about, I'm going to describe the market in the US and in Canada. Then I'm going to talk about the benefits and the limits of cyber insurance. And then I'm going to conclude on perhaps one of the biggest issues in terms of, let's say, the mid to long-term development of the cyber insurance market, which are catastrophic and systemic risks. So, the global market for cyber insurance estimated to 3 to 3.5 billion. Again, as I was saying earlier, very high growth, and it is expected to grow, to still keep growing at least until the end of the 2020s. The US market is by far the largest one. It is the global cyber insurance market. In the US, a quarter of cyber insurance risks are being underwritten by Lloyd's of London and the different underwriting syndicates at Lloyd's. And the top 3 insurers in the US account for 48% of the global market. So we see here how Lloyd's has a very huge position in the US market. And you see, of course, perhaps people you know here, like our friend Warren Buffett at Berkshire Hathaway is in the market. So most, I would say the major property and casualty insurers are, of course, in the market. So where does the market comes from? The cyber insurance market is a legal construction, right? And its business model has also been legally and politically constructed. The market emerged in the 1990s following the establishment of data privacy and security regulations in the US. So the market first emerged around cyber liability risk, right? So in contrast to cyber risk in general, involving a business interruption, even today physical damages, etc. So at first, regulatory penalties and legal expenses created insurable costs. So this opened the market for insurers. In a second time, in the early 2000s, mandatory breach notification laws, first in California, kind of expanded the market to cyber risks more broadly, right? So as I was explaining, non or extra liability risk that insurers started covering. So the important thing here is that mandatory disclosure create an incentive for insured organization to actually claim their insurance policies despite, for instance, reputational risk, right? So without mandatory breach notification, the market would have a hard time expanding. At first, insurers were selling third-party coverage, right, for organization dealing with other organization owning IT systems. And then we observed a move towards first-party coverage, through which organization owning networks and software and being contractor with other people, with clients, could cover themselves. So, of course, in third-party coverage, the market was revolving around privacy liability, whereas with first-party coverage, we're moving towards broader cyber risks. So you can see basically everything now being included, every kind of cyber risk having the possibility to be included in a cyber insurance policy. At first, cyber was insured as a product, meaning that it was sold as standalone policies, whereas today we're moving towards cyber as a peril included within package commercial policies. I'll come back on this. In Canada, as you know, there was no mandatory breach notification regulation until 2018. So we can see that the market has lagged behind the US quite a lot. Even despite other types of regulation in the US, like in Canada, like the anti-spam, the provincial ones, and most recently GDPR. As a result, the focus in the cyber insurance market in Canada has been cybercrime and business interruptions. As we can see from the 2017 Canadian Survey of Cybersecurity and Cybercrime, we see a huge interest in coverage for direct losses from attack or intrusion, whereas, as you can see at your right, security breach remediation and notification expenses are much less sought by insured organizations. And unsurprisingly, I would say, the largest, so we see blue, small businesses, red, medium-sized business, and green, large business. Again, in terms of security breach coverage, large businesses are buying some. So I would say this is not surprising, but we see here, I would say, some of the result of the kind of recent implementation of mandatory breach notification in Canada. So historically, take-up rates in Canada have been quite low compared to the US. Unfortunately, there's not, I would say, reliable data on this. I was surprised to see a recent survey from Ovum and FICO, a firm of 500 employees and more, suggesting that Canada is now almost is higher than the US in terms of cyber insurance take-up rates. So the US went from 50% in 2017 to 76%, whereas Canada would now be at 78%. I was a bit surprised and skeptical. I kind of guess there's issues of representative sample in this study. The study does not exactly explain its methodology. Anyways, in Canada, maximum coverage for cyber insurance is around 20 to 25 million, whereas in the US it's much higher. And the average cost per breach in Canada is estimated at $255 per records. So how about the benefits of cyber insurance? Of course, insurers act as breach coaches. So insurers provide legal and cybersecurity services to organizations, especially, I would say, for SMEs with less resources, right? It allows to outsource expertise and services. It still offers financial protection to SMEs, and there's not much literature and study on this, but I guess we can say that the coverage conditions included in cybersecurity, cyber insurance policies push organization to improve cyber hygiene. But can we say that cyber insurance as a whole will lead to greater cybersecurity? Let's, for a moment, think about fire insurance. So at first, when fire insurance emerged at the turn of the 17th century in England, I mean, London was struck by the numerous and continuous fires. Insurers started by noticing the issue and putting in place private firefighting brigades. Quickly, everyone noticed that it was not an efficient way to counter fire in urban settings because, among other issues, private firefighting brigades would first go protect the most valuable properties. So when we think about fire insurance, I mean, the whole job of risk reduction and risk control is not being made by insurers, right? It's being made by public firefighting forces and public code and other safety regulations, right? So I feel we have to turn to what is being made in terms of policy and other, let's say, non-insurance cybersecurity initiatives. Other issues, so yeah, the main limits and risks with cyber insurance. So first, insurers and reinsurers admit themselves that they have limited knowledge of cyber risk, right? There's few historical events and data being available right now. So quantifying and modelizing cyber risks for insurers is still very difficult. For instance, they're trying to base their modelization on hurricane modelization, but there's a lot of issues with this. I will come back quickly also. Secondly, a lot of market stakeholders, and even insurers are worried that coverage conditions attached to cyber insurance policies could lead to greater standardization, right? And so there's a fear of kind of cybersecurity monoculture being promoted by cyber insurance, perhaps in the mid to long run. Thirdly, and this is very important and interesting, at least to me, coverage is customizable, often ambiguous and implicit. So on the one hand, there's lack of legal precedent in the cyber insurance market. So of course, insurance litigation is a classical thing. You won't be surprised here, but so the legal process have not been able yet to kind of push insurers to clarify what they cover, their terms and conditions. Secondly, and one example of this is, and this is discussed by most market stakeholders, is what we call silent coverage. So especially when cyber is covered as a peril within other commercial policies, a lot of potential risks are not even known. So insurers don't even know themselves what they could end up paying for, right? For instance, in a lot of policies, the concept of computer is not being defined, or networks. And think about it, this is a big issue when you're a client, your policy is unclear, you got a cyber attack or a cyber event occurring, you turn to your insurer, and the insurer refuses, denies your claim, right? So silent coverage is a big problem still today. People like at AIG recently announced they will be reviewing all of their cyber product to clarify and get rid of this issue of silent coverage. A good example of this is the gray area between cyber and terrorism within private insurance coverage. As soon as a cyber attack would be deemed as an act of warfare, for instance, by a given government, a lot of cyber coverage would kind of fall apart, right? Another issue with private cyber insurance is that it could lead to greater cyber insecurity. For instance, you might have seen this. ProPublica published this study a few months ago, explaining how a lot of insurers quickly pay for ransoms, right? And so this is a big issue. Why would they do this instead of, getting legal and cybersecurity teams in the organization and doing the hard work? Of course, because it saves them costs, right? And in doing so, it decreases pressure on future premiums for their insured, right? And so ProPublica talks about an extortion economy being promoted, perhaps, thank you, indirectly by the cyber insurance market, whereas insurers are indirectly funding criminal and terrorist organizations. And so the coverage uncertainty due to silent exposure I'm talking about leads to exposure uncertainty. So insurers are not even sure how a major cyber attack or event could affect their own portfolio, right? For instance, and I'm going to try to conclude quick, they fear that cyber catastrophes could create risk aggregation management. So how would they deal with one cyber catastrophe leading to claims of either other cyber insurance policies or other insurance policies? So this kind of cascading effects. So I'm going to go quick here. The reason why cyber catastrophes could be very problematic for the insurance industry is because of the nature of risk interconnectedness within the digital space. So if you think about the standard traditional life insurance policy, if one person dies, the neighbor is not affected, right? Even with some floods, so environmental catastrophes, risks are spatially interconnected, right? Meaning that one major hurricane will lead to claims from car insurance, business insurance, home insurance, perhaps life insurance, but in a located geographical areas. Whereas with cyber catastrophes, risks are digitally interconnected. Law of physics do not apply. So this is a big issue for the insurance industry in terms of systemic risk. There has not been a true cyber-insured or insured cyber catastrophe yet. Not Petya, WannaCry, interesting here. Especially WannaCry because even though it led to low insured losses, as you know, more than 300,000 firms and 150 countries have been affected. So this is partly why insurance and reinsurance insiders are very concerned about the cyber insurance market. So for instance, Dennis Kessler, CEO of a major French reinsurer, suggested that costs from cyber will dwarf those from environmental disasters. Stephen Catlin, former head of the largest Lloyd's cyber insurer syndicate at Lloyd's, and former, I think, owner of Excel Group, suggested that cyber is the biggest, most systemic risk being insured. I could talk about the catastrophic scenarios being discussed by insurers and reinsurers. I have no time. Capital One, Amazon Web Services being a very interesting one. Why? Because cloud computing is only in its beginning. It's a very concentrated market, at least for now. And it is growing very quickly. And insurers are worried that it will increase interconnectedness, right? So to conclude, we see that there's a potential for private cyber insurance to increase cyber insecurity through standardization, to some perverse cybersecurity incentives created by insurance. Perhaps also because insurers will lack some incentive to develop in-house cybersecurity expertise. And so there's an issue of financial stability with cyber insurance because of the interconnectedness it is involved in. Even the financial transfer of a catastrophic cyber insurance risk is not sufficient right now. For instance, reinsurance transfer is has not been developed in a huge capacity. So people like CEO of a Swiss reinsurer, Christopher Momentaler, suggested that cyber is probably not insurable. But why is the market still growing? Why are people like Stephen Kittling suggesting that our balance sheets are not large enough to pay for that? I suggest to conclude by saying that because insurers, in the last analysis, rely on government, right? On government to regulate their own portfolio. Big issue here, no capital reserve regulation on cyber for insurers, no public backstop. So this would lead, in the context of a major cyber catastrophe, the state to act as the ultimate risk manager, right? The state will act and be there when everything goes bad. So no surprise that people like Warren Buffett declared last year, I don't think we or anybody else really knows what we're doing when writing cyber insurance. Thank you very much.